This is On the Charts with Nick Radge, your Australian stock market update, highlighting stocks on the move so that you can invest with confidence and success.
The information in this podcast is general advice only and does not take into account your personal situation. Please consider if it is appropriate to you and consult a licensed professional before making any investment decisions. The information provided is believed to be accurate at the time of recording.
Welcome to the On the Charts podcast, episode 191 for Tuesday, 9th of May, 2017. With the French election out of the way and US earnings all but done and dusted, there's not much happening in the US equities market at the moment. Volatility has fallen to its lowest levels in at least 20 years, and any traders needing volatility to profit will be struggling in this environment. Shares in Apple continue to flourish. The big tech company jumped another 2.7% last night and ploughed through the $150 mark for the first time, making it an $800 billion company. Sentiment will most likely remain upbeat until the iPhone 8 is released in September. Apart from oil, most commodities slipped last night. At the close, the major indices were more or less unchanged. And the next major focal point for global traders is the OPEC report due on May 25. Australian markets took a step backward today ahead of tonight's budget after it was leaked that a new levy on banks would be unveiled. The levy would not be aimed at the general public, rather the larger institutional loans that the big four banks make to each other. This additional tax has spooked investors, with all the banks retreating. This didn't help the negative sentiment after Commonwealth Bank reported earnings slightly below expectations as well today. The underlying profit for the bank was about 6% below consensus and highlighted the weak revenue environment. The Aussie dollar also continued to fall after retail sales showed a surprise fall. Annual growth in retail turnover fell to a 5-year low. And Alan Joyce, CEO of Qantas, copped the cream pie straight in the face during a talk at a Western Australian leadership event. Clearly, the culprit isn't a shareholder, as the stock flew to a new 9-year high today, so it's not clear what sparked the attack. Speaking of Qantas price action, we mentioned just last week that we expect a considerable upside is yet to come, and today analysts at Credit Suisse suggested a $7 handle is quite possible. Retailers fell hard today after yesterday's plunge in Myer after analysts downgraded the outlook ahead of this Friday's earnings report. Harvey Norman was down 3.5%, but initially was 6% lower. JB Hi-Fi slipped 4%. Analysts have also been quick to point out that the poor retail sales data is pointing to growing concerns about the health of the household sector, which is also weighing on retailers. At the close, the banks heavily weighed on the index, which finished near its session lows, down about 0.5%. CBA fell 3.9%, NAB lost 2.2%, and Westpac slipped 3.5%. The small caps, however, had a positive day, up 0.6%. Shares in Bendigo Bank are poised to go lower, also says the pattern progression on the charts. Broker consensus is a comprehensive sell, as the widening differential with investor loans between itself and the big four banks, weaker results, and the dividend payout ratio may also be in doubt. Of course, there's also the looming earnings risk due to strong Sydney and Melbourne house prices, and increasing mortgage rates above the big four has slowed demand. Technically, 2016 was a strong year for Bendigo, although that strength was deemed to bounce rather than a sustainable trend higher. We now see strength as terminated and a reversal of form taking shape during 2017. Retracements tend to unfold in 3 waves, and it may well be the start of the third wave lower has just begun here. If correct, we'd expect Bendigo to track back towards $10.50, maybe even down towards $10 before a better buying opportunity arises. In the same vein is Bank of Queensland, which we highlighted several months ago after it offered some technical bullish posturing. Well, that's beginning to fail, and we're the first to be able to say we're wrong and cut to a good defence. The consolidation that we've been looking for now appears to be taking on a more complex quality and suggests a little more downside is probable. First half cash earnings were below analysts' expectations, mainly due to a miss in revenues, and competitors are also taking their toll. The bank is just unable to match price, and as such, the mortgage book faces headwinds. Whilst the bank is in a strong capital position and offers an attractive yield, the sector in general remains out of favour and will weigh across the board. Technically, the late 2017 thrust was very promising and one of the key reasons we had high hopes. However, consolidation patterns can be very messy, complex, and extend beyond their allotted time, which appears to be the case here. Assuming that is the case, Bank of Queensland shares should continue to dip back towards $11. A strong thrust down and through 10.75 would be a real red flag for us and would require further assessment. But a slow drift down on light volume could set up a great buying opportunity. My name's Nick Radge, and I look forward to seeing you on the charts tomorrow.
On the Charts with Nick Radge, brought to you by The Chartist. Join Nick and the team at Noosapalooza Trading and Investment Conference, 20th and 21st of July in beautiful Noosa, Queensland. Visit thechartist.com.au and click on Noosapalooza in the menu for details.